Welcome everyone. Today, we're going to delve deep into one of the most fascinating concepts in finance, money creation. We'll break down what it is, how it happens, and its implications on the economy. Money creation is the process by which the money supply of a country or a monetary region is increased. This can be done in various ways, including central bank policies, fractional reserve banking, and more. To understand this better, let's begin with the role of central banks. A central bank, such as the Federal Reserve in the United States, is responsible for the monetary policy of its country. One key tool they use is open market operations. Open market operations involve the buying and selling of government securities in the open market. When the central bank buys securities, it increases the money supply because it credits the banks with more reserves. These additional reserves can then be used by banks to create more loans. For example, let's say the central bank buys $1 billion worth of government bonds. This money is credited to the banks, which then have more reserves to lend out, thereby increasing the money supply. Now, let's talk about fractional reserve banking. In this system, banks are required to keep only a fraction of their depositors' funds in reserve, lending out the rest. This means that for every dollar deposited, banks can lend out multiple dollars, thereby creating more money. For instance, if the reserve requirement is 10% and someone deposits $1,000 in the bank can lend out $900 of that deposit. This $900 can be deposited in another bank, which can then lend out $810, and so on. Let's visualize this with a simple data chart showing the effect of a $1,000 deposit in a fractional reserve banking system with a 10% reserve requirement. As you can see, the money multiplies. This is known as the money multiplier effect. The formula for the money multiplier is simple: 1 divided by the reserve requirement ratio. If the ratio is 10%, the money multiplier is 1/0.1, which equals 10. Here's a quick question for you. If the reserve requirement ratio is 5%, what is the money multiplier? Think about it for a moment. If you said 20, you are correct. The money multiplier would be 1 divided by 0.05, which equals 20. This means each dollar in reserves can theoretically create $20 in the money supply. Now, let's move on to the role of commercial banks in money creation. Besides lending to individuals and businesses, commercial banks also create money when they issue loans. For example, if you take a loan from a bank to buy a house, the bank does not give you physical cash. Instead, it credits your account with a deposit, thereby creating new money. This brings us to the concept of book money or bank money, which is the money created by commercial banks in the form of bank deposits. While this money is not printed, it functions as money because it can be used for transactions. Let's visualize how this works with a straightforward example. Imagine you take a $200,000 mortgage from a bank. The bank credits your account with $200,000. This money did not exist in the physical form before. It was created through the loan. Here's a thought-provoking question for you. How does money creation affect inflation? The answer is complex. In theory, increasing the money supply can lead to inflation because more money chases the same amount of goods and services. However, other factors such as supply chain issues, demand fluctuations, and market expectations also play a significant role. To better understand the relationship between money supply and inflation, let's look at historical data from the US. Between 2000 and 2020, as we see from the graph, the relationship between money supply and inflation is not always straightforward. While an increase in money supply often leads to inflation, it is not the sole determining factor. In summary, money creation is a complex but crucial aspect of modern economies. It involves central banks, commercial banks, fractional reserve banking, and other mechanisms. Understanding how money is created and its implications can help you make more informed financial decisions. Thank you for watching. Don't forget to subscribe for more in-depth financial tutorials. Leave any questions or topics you'd like us to cover in the comments below.